Welcome to What is Private Equity? Unlocking Growth Beyond the Stock Market. This video is designed for curious minds, aspiring investors, and anyone looking to understand a powerful force in the financial world. We'll demystify private equity, explaining exactly what it is, how it works, and its significant impact on businesses and the economy. By the end, you'll have a clear grasp of this often misunderstood investment strategy and its role in fostering significant business growth. Have you ever wondered how some private companies grow exponentially without being listed on the stock market? Or how established businesses get a major financial boost to innovate and expand? The answer often lies in private equity. It's a fascinating world of investment that fuels growth, transforms companies, and creates value behind the scenes. At its core, private equity, or PE, refers to investment funds that buy and restructure companies that are not publicly traded on a stock exchange. Unlike buying shares of Apple or Amazon on the NYSE, PE involves direct investment in private companies, often taking a significant, even controlling, stake. Think of it as investing directly in the future of a business, rather than just its current public valuation. The key difference is ownership and access. In public markets, you buy small pieces of large, established companies. In private equity, sophisticated investors pool capital to invest in, improve, and then sell private companies. It's about active involvement, strategic restructuring, and long-term value creation, not daily stock price fluctuations. So how does this process actually work? Private equity operates through a distinct cycle, from raising money to ultimately selling off investments. Let's break down the typical journey of a private equity fund. First, PE firms raise capital from institutional investors. Think large pension funds, university endowments, insurance companies, and wealthy individuals. These investors commit significant sums, creating a large fund that the PE firm manages. Once the capital is raised, the PE firm identifies promising private companies. They then acquire a substantial, often majority, ownership stake. This isn't just buying shares, it's buying into the company's future, aiming to take an active role in its strategic direction. This is where the real work begins. Private equity firms don't just buy and hold. They actively work to improve the acquired companies. They might bring in new management, streamline operations, invest in technology, expand market reach, or optimize financial structures to unlock the company's full potential. After years of improving the company, typically 3 to 7 years, the PE firm looks for an exit strategy to realize their investment and generate returns for their investors. Within the broad umbrella of private equity, there are several distinct investment strategies. Today, we'll focus on two of the most common: leveraged buyouts and growth capital. A leveraged buyout, or LBO, is a strategy where a PE firm acquires a controlling stake in a company using a significant amount of borrowed money. The debt is typically secured by the assets of the acquired company itself. The goal is to improve the company, reduce debt, and then sell it for a profit, making the equity portion of the investment highly lucrative. Growth capital, on the other hand, is an investment in a relatively mature company that needs capital to expand or restructure operations, enter new markets, or finance a significant acquisition without changing ownership or taking on excessive debt. It's about fueling existing potential. Private equity plays a crucial role in India's booming economy, fostering the growth of many well-known businesses. Let's look at a couple of prominent examples from the Indian PE landscape. One notable example is Kedara Capital, a leading Indian PE firm. They invested in Vijaya Diagnostic Center, a major diagnostic chain. Kedara helped Vijaya Diagnostic expand its services and reach, ultimately leading to a successful initial public offering, showcasing how PE can transform and scale businesses for public markets. Other significant players in the Indian private equity space include Chris Capital, known for its investments in technology and financial services, and the Everstone Group, which has a diverse portfolio across various sectors. These firms consistently contribute to the scaling and professionalization of Indian enterprises. Beyond the financial returns for investors, why should you care about private equity? Its impact extends far beyond balance sheets, influencing economic growth, job creation, and innovation. Private equity firms provide not just capital but also strategic guidance, operational expertise, and access to networks that help companies scale, innovate, and compete more effectively. They often transform struggling or stagnant businesses into market leaders. PE investments often serve as a launchpad for companies to eventually go public through an IPO, or become attractive targets for larger corporations through mergers and acquisitions. This creates dynamic capital markets and opportunities for further investment. By fostering business growth, private equity indirectly contributes to job creation, as expanding companies need more employees. Furthermore, their focus on innovation and efficiency can drive advancements across various industries, pushing economic boundaries. In summary, private equity is a powerful investment strategy that goes beyond public markets. It's about active ownership, strategic transformation, and unlocking the true growth potential of private companies. From raising capital and acquiring stakes, to driving operational improvements and exiting investments, PE firms play a vital role in fueling economic development and creating value for businesses and investors alike. It's a dynamic force that truly helps unlock growth beyond traditional avenues. Please remember, this video is for educational purposes only and should not be considered financial advice. Investing in private equity involves significant risks and is typically suitable only for sophisticated investors. Always consult with a qualified financial advisor before making any investment decisions.